who want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Chris Chawson, Head of Research for Morningstar.
Hi Emma.
So we're here today to talk about price. It is one of our 5 Ps, one of the things that we consider when rating a fund here at Morningstar. Why is price important?
Yeah. Well, there's 2 ways to think about it. There's, first of all, vast quantities of academic research, including some of our own research at Morningstar, that shows that it's one of the better predictors of future outperformance of funds. The second way to think about that is more intuitively is just to say lots of things are outside of our control in the investment world. Managers come and go, styles come in and out of favor, markets can go up and down, but price and the cost you're paying for that fund is the constant, and it's a constant negative alpha effectively, because you don't pay for beta, being applied to your return stream year after year after year. So the more you can do to manage that constant in your favor, the better off you are as an investor, all else being equal.
It's not that easy to do all the time though, is it? Because the price that you can see easily that the fund manager may represent is not always the full price that you pay.
No, you're very right about that. So what's called an AMC or a management charge here in the UK may or may not include certain other elements. RDR has made a huge difference because now the distribution element is outside the fund context, and that helps you, but there can be custodian fees and admin fees and all sorts of things. The big element that's not disclosed anywhere is the trading costs of the fund, and that would include everything from brokerage commissions, but also market impact or opportunity costs. So if you're running a big fund and you're a manager, if you make a trade all at once, you might drive that price up or down against your favor and cost yourself money. If you spread it out over time to sort of tamp down that market impact, the price could still move against you over that time. It could cost you. So that's one of the areas where investors don't have much information, and that can be easily higher than the ongoing charge itself in some cases.
So let's take a simplified form. Let's say that a fund delivers 3% a year and you have a choice between fund A that charges you 1% and fund B that charges you 1.5%. Well, of course, all other things being equal, you're going to go for the 1% fund. Yes. However, price in isolation should not be the only consideration for investors, should it? We have 4 other Ps that we tell people to take into consideration. Perhaps you can explain a little bit more about why price should not be your only concern.
Sure. I mean, it's like anything. You know, you wouldn't just go by the cheapest of anything unless it was a complete fungible commodity, right? So I would tell you if you're going to buy a passive fund, for example, price should dominate your decision. You need to ensure they're competent in tracking the index, but beyond that, there's no reason to pay extra for index fund management. With active managers, it's a bit different. There's a lot of levers being pulled. There can be different levels of experience. There can be different levels of complexity in the portfolios. So we do take all those kinds of things into account when we form our Morningstar Analyst rating on funds. And as you know, we're looking at people, we're looking at parent, process, performance, in addition to price. And so it's one factor we look at. And when we analyze the parent company, we look more broadly at the trend of how they price their funds and try to pick it up there as well. But we do think it's a factor you should consider, particularly if the fund's an outlier. So that's when we start to get very concerned when it starts moving out into that top or bottom quintile or quartile of fees within this peer group. We think that's cause for tremendous concern. But even then, the question is, how many levers does the manager have to pull to add value? Do we think he can overcome that fee in the future? And has he shown that ability in the past? So with an asset allocation fund that has broad spectrum to move exposures around and take on different kinds of risk, if we think somebody's got a lot of skill at that, that might justify a somewhat higher fee. Whereas if you're talking about long-only equity with a fairly low tracking error, you wouldn't want to pay very much at all.
Chris, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.